We are a little more than 2 months until the end of the year, and the S&P 500 is up more than 20%, while the TSX is up more than 17%. And these gains come after a sharp policy U-turn by central banks like the Bank of Canada and the U.S. Federal Reserve, which carried out jumbo-sized rate cuts recently. My next guest has come with a report called U-turns, and Brad Simpson is Chief Wealth Strategist at TD Wealth. Lovely to have you here.
It's great to be here.
I'm looking forward to digging into this. It's a great report, and so again, thanks for handing it over to us. We can talk about it. You say there are few things that financial assets like more than rate cuts, and so that is happening.
Yeah, I mean, we wrote this document, and quickly it was very clear U-turns were it. And if you're kind of looking at 2022, interest rates were going up. Asset prices were going down. Here we are in 2024. Interest rates have been going down. And of course, we brought a chart along. If you want to look at risk assets or risk control assets right across the board, I mean, they're all, for the most part, up and very positive. And you can thank central banks once again for that, and just shows really how addicted we are to interest rate policy.
Yeah, well, it'll certainly be good for pretty much everything on that screen there, which I guess is the point. In your report, you talk about the idea that if to understand what really drove these central bank policy U-turns, you have to look at the global business cycle to understand what's going on, and you have a chart that's painting an interesting picture of that. So let's bring that up and tell us what we should be looking at.
Yeah, and I think the starting point is we have a global economy, but we have a global economy that is actually quite desynchronized, which I think is important, because it shows that in the world that we live today, more and more the economies and countries are kind of running on their own direction, right? So, I mean, the starting point when we look at it is think about Europe. Even though interest rates are headed lower there, this is an economy that, quite frankly, is right on the precipice of a recession and very slow. And when you look in the coming quarters, it doesn't look like it's going to get a whole lot better. On the other side of that, you can look at Canada, which has a very similar construct as an economy, but is really headed in the opposite direction. And so that makes you think on how you're going to start allocating capital. And of course, the big change in the quarter really was, if you're looking for a U-turn, is China, and the significant policy change there, both a fiscal policy and monetary policy. And for the last couple of years, we've been saying, things are slow there. I mean, their economy is slow, their political environment is very difficult, their social environment is very difficult, and
which prompted the change.
Yeah, and after being really deaf to it, it really does seem the government there has finally acknowledged, we have a problem.
In a big way.
And that in a significant way. And so that also has an impact on where the rest of the economy is going. We've got the second largest economy in the world there. And, by adding fuel to that, potentially has a really big impact from here for the rest, and particularly the United States.
One thing I know that your report highlights and says that one of the risks that you're looking at is the deterioration of the U.S. labor market, and to be clear, the faster than expected deterioration of that market. Tell me more about that.
Yeah, and so for clarity on that is that, if you look at what the financial markets look at today, and you go, what is going to be the big driving force of it? It's the U.S. economy from here. And I think that if you wanted to circle the thing you really wanted to watch, it would kind of come down to what does employment look like there, and what does the consumer look like? And so we are starting to see the consumer starting to slow. We are starting to see that the employment has started to slow there as well, but not in a significant way. And I think that's important, because typically what we would see, and I think that's what's made this such a difficult environment to figure out, is that more often than not, you would think that the U.S. economy would be moving into a slowdown and potentially into a recession. But the reality is we're more and more getting comfortable with the soft landing scenario and seeing it very quickly just kind of turn around and make its way back up again. And so watching employment, because that's really the last one, which still you're at 4.2, 4.3, like that's full employment. But inside, you're starting to see that slow, and that's what we meant to there. If you were going to see a red flag, that would change that scenario. That's the one to look for. but when we look at it, we think it's pretty unlikely.
Yeah, we'll come back to that too, but because part of the reason maybe it might be unlikely is because we have a U.S. election coming. We are days away at this point, and you believe that we could be seeing another U-turn. I mean, obviously it's going to be based on who comes into office and what happens, but with one of the candidates, there is some pretty significant abrupt changes that might be promised and might be coming to fruition.
Yeah, you know, like I think if we look at this election and you look at the economy, and both of these are really are at an important inflection point. And you know, I think and we think, look, whomever wins this is that it would all things being equal, the U.S. economy is headed in a good direction.
Yeah.
If there was a Republican win, it certainly looks like there would be a lot more deficits coming, which could be more inflationary, which could lead to higher rates, so there would be issues there. But I think probably the most important thing that we really wanted to point out, and really the chart that we brought along is that I've been a little bit frustrated, quite frankly, with financial service and some of the research in firms and some of the research that has come out. Because a lot of it's kind of been like stuff like, well, if in the last 4 or 5 elections, if the Democrats win, this is what markets do, and if the last 4, this is what markets, and if the Republicans win, this is what markets do. And what we wanted to do is look back in time and say, this is a significantly different election. And so what we did is we actually went back through the U.S. history and went back and looked at times where there was division politically there. And if you look going back to their beginning, the division that is currently in the United States is very similar to the period of just before the Civil War, the Gilded Age, which would be, call it late 1870s to the end of the 1890s, which was a time really similar to now, but with a lot of division. The end of the Second World War, which again was in a time of massive division there.
So the higher, and sorry, excuse my stupid question, but the higher the green line, the greater the division.
Yeah,
okay.
yeah, and I think the important point of this, if you look at those as inflection points, the positive one is ultimately the nation is still together, even though that during these times it was very divided. But I think that it's important for us in an organization that thinks the most important thing as an investor is to make sure you're well diversified and building a diversified portfolio to protect for downside risk and volatility. An environment like this, an election that's coming up, there is certainly uncertainty. And if there is uncertainty, the one thing that can create volatility is if we have post-election a lot of uncertainty on what's going to happen. Because that rule of law is incredibly important to financial markets.
Yeah.
And we're
granted a premium for it.
Yeah, we are, and they are. And I think the important point I want to make to this is it's not a dire warning. It's just saying that to not keep your eyes open with it.
Correct.
We're in the business of managing risk, and while there's a lot of things to be very optimistic about, we think this is a wise thing to be managing.
So you've got your sense here in terms of asset allocation. Let's start with fixed income. What are you thinking?
Well, we just made a change for our allocation committee, so we are now modest underweight fixed income, and we still like fixed income, but I mean, much of our discussion today is about a stronger economy than expected, and if you have a stronger economy than expected, most of the rate declines, we may see short-term interest rates go down more, but longer term probably going to be more sticky in an environment like that, and going kind of into the election where there is concern about deficits and inflation, and on both parties are concerned about large budget deficits. Both of those put a little bit more uncertainty on fixed income markets. So for now, we've gone modest underweight.
Equities?
Equities, so from that modest underweight, we have gone to modest overweight equities. And again, in an environment where you look at the U.S. economy starting to kind of go through a soft landing and turn up again. And then you look in Canada, then all of a sudden you see better policy, both fiscal and monetary out of China. Both of those point to better and broader markets. Actually brought a chart along of the S&P 500 where you can see that it isn't just the Mag 7 anymore.
Yeah,
These are
it's broad.
The vast majority of companies are now trading above their 200-day moving average. And that's a much healthier market, so that's why we've made that move there.
What about alternatives?
Yeah, well, alternatives are a big bag and kind of a catch-all, right? So We are currently modest overweight there, but we've made some changes. We've reduced our private credit rating. Now I want to be clear on that. We still really like private credit. It's really a reflection of the Canadian market, and much of the way you can allocate to private credit in Canada publicly is probably the place just for valuations. That makes sense. We still like US and global private credit an awful lot, but I think you look there. Real estate, we've also started to become more positive there, and so we're starting to see some light at the end of that tunnel, anyways. There, so we've changed that as well.
All right, and even within each one of those, there's many different ways to slice it. So
Correct.
Let me ask you about a last one, and we've got a couple minutes here. Commodities. What's your take on? And again, commodities is a big bag too.
Yeah, well, but I confess it's a big bag that we like an awful lot, and for the first reason is that. Much of our discussion today has been things that are geopolitical, and we live in an environment in a world that has a lot more geopolitical volatility to it now. And one of the ways you want to diversify is using commodities. And so I almost think I start to sound like a broken record, but I also know that most people are underexposed there. So we definitely want that as part of folks' portfolios. And the other one is that you go to any major industrial nation and go to an urban center, there's an infrastructure build out somewhere.
Yeah.
And then you turn that, even if we're in the middle of a green revolution, that's also going to be an infrastructure build out. And so we think we're in the middle of a commodity super cycle. And so you kind of take it as a good diversifier and a longer term strategic hold. We continue to like commodities.
I wonder with commodities sometimes, like you're right, between nearshoring, reinvigorating all the infrastructure, the green infrastructure. I mean, there's so many positive reasons behind commodities.
Yeah.
It just seems like everyone's really kind of pushing that direction, and yet there's some people, you're right, that still seem quite underweight.
Well, I think one of the reasons Canadians is because so much of the Canadian indices are made up of oil and gas and metal and minerals.
Yep.
And the reality is that a basket of commodities moves very differently than a publicly traded equity entity. And so I think that's part of it, but it is apples and oranges. And so we think that's probably the biggest reason I think that holds people back.
All right. Well, great report, Brad. Thank you for joining us, and I encourage everyone to take a look at the U-turns. It's some good stuff.
Thank you.